you need to know what's going on in the world. But that can sort of lead you into the sort of the crowd mentality, what's on the front page of the FT, what's moving markets today. And that's unlikely to be the places where you're going to find the best opportunities. So to observe the world and get insight.
Hello and welcome to today's episode of Ruffer Radio. I'm Gemma Cairns-Smith, an investment specialist here at Ruffer. And today I'm delighted to be joined by Jon Dye, who we've recently announced from October will be joining Henry Maxey as our Co-CIO. So firstly, Jon, welcome and congratulations.
Thank you.
We're really excited for you. I thought the purpose of today's podcast could be to just get to know you a little bit.
Mm-hmm.
So starting off, you've been at Ruffer now for just over 16 years. You joined us back in 2010 as head of research. How did that come about and what made you join Ruffer?
Yeah, well, in the run-up to the financial crisis in 2008, I was introduced to Henry Maxey by someone that we'd both worked with independently who thought we might be interested to meet each other. And we certainly were and had many great conversations around the GFC at the time. And I'm someone who's worked doing both kind of macro investing and research, and then also done a lot of stock-based research. So to bring those two things together and come to Ruffer, where both of those things are relevant and some more at different times, and where I can focus my energies and lead that research effort, that was how it all started.
Great, and obviously 16 years is a really long time. So what's kept you at Ruffer during that time frame? What is it that makes Ruffer a special place to work?
Yeah, well, I've kind of alluded to it. I mean, it's the at least in part the variety of the work and the ability to kind of think creatively about how we structure portfolios, and alongside working with lots of smart people who are trying to do the same thing, keeps things interesting. Jonathan always had he had this idea of offsets, and he had a nice phrase for what he meant by that, which was this juggling of nuclear weapons, which is putting a portfolio together with risky assets that have the scope to not only work in their own right, but also to offset each other in different states of the world, so that we can deliver the returns we're looking for clients. And that's quite a hard thing to do, and it involves quite a lot of creative thinking in putting that portfolio that works that way together, and that's a lot of opportunity for learning new things along the way in trying to pull that off. And then more latterly, in the last 5 years, I've been running a bottom-up equity portfolio, which has kind of extended the learnings, getting more into the company side, which has been and taking risk directly for clients. So that's the quick wrap.
And you touched on it already, but obviously becoming co-CIO, your relationship with Henry will be very important. How would you describe your working relationship? How do you complement each other?
Well, sure. I mean, we've worked together for a long time in different sort of iterations and guises, so we know each other very well. Just to give you an example, we in the 2010s we had a large part of the portfolio was invested in Japan, and we spent a lot of time traveling there.
That sounds exciting. A bit jealous of that.
It's fun, a little bit exhausting too. So I mean, I start, and the investment from my perspective in equities in Japan starts from a kind of point of view of what it started from a point of view of. The valuations are extremely attractive. We had banks on very low price to book multiples, high dividend yields, kind of basic valuation metrics like that. That kind of piques the interest, makes it interesting. So that's the kind of more like the bottom up as a starting point, and then Henry would be more on the macro insight is that the policy making architecture needs to change and is going to change in Japan. Find me some assets that might represent that, and as he's if you sort of, it's a bit of a caricature, but if he's a macro guy who understands stocks, I'm a stocks guy who understands macro. If we can blend those two insights together, find really fantastic ways to play the macro insights, then that's probably how we can work together at its best. Yeah.
So we've touched on it briefly, but clearly in 2021 you moved from being head of research to lead our bottom-up equity portfolio. What was your approach to running that portfolio and risk-taking?
Yeah, I mean, I'm not sure. Well, we could probably spend an hour on this, but I'll try and give some key takeaways. I think it's important to be fairly kind of style agnostic and go where the opportunities are, and that can vary quite a lot through time. Also, I think a contrarian streak is kind of helpful in that context as well. And I mean, I'm certainly value oriented. I'm not value biased. I mean, I think there's a sort of slight nuance on that. I mean, obviously you've got to be careful with the prices you're paying. That's very important. But that's not the same thing as only buying stocks on 5 times PE multiples.
And throughout the series track record, 2022 is clearly a standout year because your equity portfolio delivered positive returns in a year that was very, very difficult for global equities and global bonds. So how did you go about that? What did that look like for you?
Yeah, well, I think the macro overlay and having a background on that side of things certainly helped. We had the overhang of all the stimulus from COVID that was still in the system, overlaid with various supply shocks through the global economy, which we thought would translate into higher interest rates than people were expecting, and that certainly proved to be the case in order to fight inflation. So we were able to back a number of ideas that would benefit from rising interest rates that were trading at were either being ignored or trading at discounted valuations, such as Irish banks or Jackson Financial, which was a life insurance company. And there are also quite a lot of idiosyncratic ideas that came post-COVID, where the COVID era had kind of really beaten them up, such as Rolls-Royce, which was a nice kind of restructuring and transformation story under new management, as we came out of COVID, and it had been somewhat ignored for a while.
And I'm going to change tact a little bit now, and I wonder if we can talk about your Ruffer Review article, which you called Always a Puzzle, Never a Game. Now, in it, you write quite personally about your father, but you also write about the deeper purpose of investing, about how the key purpose is compounding people's savings over time. So your dad clearly shaped your world view. What do you think is the most important thing that he taught you about investing?
Yeah, I think probably the simplest answer to that is, think for yourself. You need to know what's going on in the world. But that can sort of lead you into the crowd mentality, what's on the front page of the FT, what's moving markets today. And that's unlikely to be the places where you're going to find the best opportunities. So to observe the world and get insight from it while also standing apart from it, I think that's probably a very, it's kind of a high level thing, but a key thing, just to be able to, think for yourself and think independently. Yeah. And I think it comes with, it takes a bit of willpower and a bit of practice.
It sounds so simple, but I can imagine it's a lot easier said than done. And the other theme that you touched on in your article, which I just wanted to draw out, was this idea of so many people in our industry treating investing as more of a casino and that kind of risk-taking behaviour. What is it about that you think is so dangerous? Because we see it everywhere today.
Yeah, I was schooled in the dot-com bubble. I mean, that's when my career started, was in September 1999. So I remember that very well. The problem for market practitioners, not least in equity markets, is the need to sort of at least stay somewhat in the herd. It's career limiting to radically underperform the market, which does lead people into perverse behaviours of buying things that they wouldn't otherwise want to buy in order to just kind of retain the momentum in portfolios. Now, sometimes, that's just the ebb and flow of financial markets. It doesn't have a broader macro impact. But if it becomes the only thing, which sometimes happens, the only game in town, then that can roar into a frenzied period. And we saw it like we were just talking about it in 2021, some of those kind of COVID winners. And if that can then spill over into, people being their own worst enemy, buying stocks purely for momentum, what tends to happen is that, yes, some fortunes get made, but a lot more get lost on the way down, not least actually when people start trying to buy and hoping for the magic to return once the kind of the magic moment has passed. And then sometimes, obviously, as we saw in 2008, the economic spillovers can be very dramatic and underestimated. Where that actually led in, obviously, the housing bubble then led into the largest recession we'd seen in the best part of a century.
And just picking up on another theme that you discussed in your article, it was about the importance of taking a long-term view of history. Now, markets today, we've kind of touched on it already, but they're becoming increasingly myopic. And it's something Jonathan has ingrained in all of us, the importance of taking a look back over history. Why do you think that it's so important for investing?
Well, history is a great substitute for experience, basically. If you whether that's, what happened to political situation, the economic system, or corporate history, looking at the company, or even sort of, we'll say, boring things like, regulation and governance through time, what you know is that things change in ways that people didn't necessarily anticipate, and just having that broader range of knowledge of how things might evolve is enormously helpful, because it's very tempting to take today and view tomorrow as looking like today, which of course it will do. But the longer you go on, the broader the possibilities are. So in a sense, I mean, the history, looking backwards, equips you better for looking forwards and keeps you open-minded about the possibilities.
So if we keep with the theme of looking forward, as you look forward at markets today, where are you seeing the biggest risks and opportunities?
Yeah, I think that the clearest answer on the risk side is on the state of government debt and deficits. And we live in a world, and we sort of become used to it, like post the financial crisis and then post-COVID, of ever larger government deficits, the sort of year-to-year borrowing, but also the cumulative effect of that in terms of the overall debt that's there. Such that if we were to have a recession tomorrow, the usual lever of expanding the government deficit to cushion the pain is more difficult, or will result in deficits which are much larger than we've become used to. So how does that play out in terms of the politics of it, the inflationary impact of it, is a very interesting question. I don't have the answers, but I think it's definitely a key risk, because back to the earlier point, that world may look different from the one we've been used to. And also, on the other hand, in a world of those deficits and most likely higher inflation, which has been accompanying them, the scope for central banks to cut interest rates and help clear up problems is also lower. Yeah. So from a market point of view, you've got this overlay of like, well, how does the politics work from there? And also, how does the kind of the standard toolkit of central banks and government to help cushion the blow from recession, how does that play out? Feel like key risks to me. On the opportunity side, one of the things which is becoming interesting now, and increasingly so, is as the world is focused on the clear AI beneficiaries of the build-out, that a lot of other stocks are increasingly being left behind or being sold even to fund the longs on the other side, or just being as this sort of disinterest. So we are seeing some potential bargains build up. May of course go on a bit longer than that, but if it does, then there'll definitely be some major opportunities there.
And you starting to build a position in some of those opportunities?
Yes, we are. Yeah, we are. Yeah.
Great. So, I mean, we could keep talking about markets and risks and opportunities forever, but I am conscious of time. So I'll come on to our final couple of questions here. But I just wanted to ask you, as you step into the role of Co-CIO, what is it that you think that you're going to bring to this role?
Yeah, well, hopefully it's the overlap. I mean, we've talked about some of the sort of rougher guiding principles around offsets. Convexity is another one that Henry would labour on, and if I can bring some of the sort of more alpha side of things from what I've been doing into that mix, then hopefully that can be very powerful for clients.
And speaking of clients, what is the one thing that you want clients to know about you and how you think about investing?
Yeah, I think it's that I'm very open-minded, and I am very keen on fresh ideas.
And I always like to end these podcasts with a slightly different question. So for you, I've picked, what is the one thing that you would like the next generation of investors to think about or read or know? Yeah,
I have a fun answer to this one, which is I think it's to read chapter 12 of Keynes' General Theory, which actually covers a few of the bases we've been on. It's a very fun read in what otherwise is quite a dense book. And I recommend it to anyone who'll listen. It's on my team, so I print it off and give it to people. It touches on some of the kind of the market can stay irrational longer than you can stay solvent, kind of Keynes kind of cliche stuff. But it also touches on this whole idea that we've been talking around of the conventional wisdom at any point in time, and that conventional wisdom can change and will look very different in 5 years' time. And that's probably the key takeaway from it. But a great fun read on markets, despite having been written 90 years ago.
Importance of looking back over history.
Exactly.
Well, there you have it, chapter 12 of Keynes. Thank you so much for joining us, Don. Thank you to everyone for listening.